we're seeing the problems in the LBMA, which is at the heart of keeping this paper game going. It's the heart of keeping people in the dollar system. And why is that? Well, because it's based on paper. But now these central banks that I'm going to tell you about, not just recently, but for the last few years, they're buying physical gold, not futures, not ETFs or any other paper promise. And this ruins the LBMA, COMEX, Axis game. And I venture to say that those two exchanges are going to be quite redundant in the next few years. They're not going to be important.
Stores at silver in London, which, by the way, was the reason that London ran out of free-floating silver and the COMEX had to bail them out, is because the investors came in and bought ETFs, much like they did during the original silver squeeze back a few years ago. You had the TD Securities analysts come out and say, we're hitting a real physical silver squeeze now, not just a pretend one that we had a few years ago, and he's warning. And so more people are getting interested.
If you own gold or silver, stop everything right now. Because what's unfolding behind the scenes in the global financial system could change the value of your money and your future forever. Mario Innecco just sounded a massive warning. The paper-based gold and silver system, controlled by the LBMA and COMEX, is breaking down. For decades, this paper game kept gold and silver prices suppressed, maintaining confidence in the dollar. But that illusion is collapsing fast. Why? Because the world's central banks are no longer buying paper contracts. They're buying real, physical gold, billions of dollars worth every single month. Recent data shows gold prices hitting over $4,000 per ounce as global investors rush for safe haven assets amid U.S. debt chaos, geopolitical risk, and accelerating de-dollarization. Meanwhile, silver's tight supply and growing industrial demand are setting the stage for what some analysts call the biggest short squeeze in modern history. Mario's message is blunt. If you're still trusting paper promises, ETFs, futures, or fiat currency, you could be left holding the bag when the system resets. Let's break down exactly what he revealed and what it means for every gold and silver investor watching this right now.
And if you look at this chart of silver here, we have a hammer candle that formed yesterday, and usually, not all the time, but usually that is a bullish sign. That's a sign that a market that has been going down has bottomed. That's the hammer candle, Japanese candlestick technical analysis. So yeah, I spoke to him, and he said these Middle Eastern central banks, and these are countries in the Gulf Cooperation group. You can probably imagine which ones they are. Big, powerful countries in the Middle East. Well, he told me they bought $44 billion of gold yesterday on that drop. And of course, that's not futures. It's real physical. So they're taking advantage of this drop to load up on gold. Not that they haven't been loading up for since 2022, right? And last week, the same group of banks bought 27 to 28 billion. So roughly around $72 billion. Doesn't sound that much. I mean, the speculators on COMEX, LBMA trade that like nothing, because it's paper, but this is physical. And I did the calculations here. So roughly $72 billion divided by 4,000, because they've been buying since last week. I know it dropped below 3,900 yesterday, so I use 4,000 as an average. So it's quite simple. They've been able to accumulate 18 million troy ounces of gold. And in metric tons, that translates to 559.8 metric tons, so almost 560. So it's a huge amount. And there are other countries in BRICS that he told me about. One big country in South America, actually, who started buying gold again this year. They've been active in this drop. Brazil, yes, they've been buying a lot as well. And this is a symptom of this new monetary architecture. They're going to need the gold to operate in this architecture. And I asked them, these Gulf countries, where are they storing their gold? Are they buying it in London and leaving it at the Bank of England? He said, no, they're putting it in their vaults. There's a new Shanghai Gold Exchange vault that's being built in Saudi Arabia, so that's where the gold's going to go. This is a brave new monetary world, actually, and I think America is going to get on board. To be honest, you might think they won't. There's no alternative, because once these powerful countries move to gold, anything that's paper is going to be under pressure. And it's not surprising that Judy Shelton, who I mentioned yesterday, who wrote an article in the Wall Street Journal, or editorial, a couple of days ago, mentioned gold revaluation. I think that's in the cards. And we saw after the election, U.S. election last year, that in December, a lot of gold started flowing to the United States. And I think the Americans know that BRICS are moving towards this system, and they're either repatriating a lot of their gold that they might have leased over the decades, or they're adding on to that 8,133 metric tons that they have. Yes, so I hope that many of you who have followed some of the things that I've said about gold, about having gold and silver over the years, have kept your gold and silver, and that many of you who have the wherewithal will get out of fiat currency into gold and silver, because you're going to be left holding the bag if you hold large amounts of fiat currency. And this is not financial advice, of course, this is my opinion. So I think this is huge. Of course, we're seeing a lot of propaganda, a lot of trolls out there denigrating gold because it dropped 10%, that it's not a store of value anymore, even though gold on average is going up 8 to 9% in dollar terms since Nixon closed the gold window every year, right? Since the beginning of this century, for example, in pound sterling, gold's gone up on average about 10% a year. So the reason we get these sharp moves in gold is because we have a speculative market that was created on COMEX in January 1st, 1975, together with the LBMA. They worked together to keep it a speculative market.
Mario explains that the LBMA-COMEX system has been the backbone of the dollar's global dominance, not because it was fair, but because it was fictional. These exchanges allowed massive amounts of synthetic gold and silver trading through futures and unallocated accounts, letting prices be controlled without moving any real metal. But that control is slipping away. Mario cites major new data showing Middle Eastern central banks, including members of the Gulf Cooperation Council, have quietly purchased about $72 billion in physical gold over just 2 weeks, roughly 560 metric tons. And this isn't gold stored in London or New York. It's being vaulted in their own territory, including a new Shanghai Gold Exchange vault in Saudi Arabia now under construction. At the same time, Brazil and other BRICS nations are back in the market, steadily converting dollar reserves into bullion. These moves are the foundation of a new global monetary architecture, one anchored to tangible assets instead of paper debt. Mario connects this shift with recent policy chatter inside the United States. Former Fed advisor Judy Shelton wrote in the Wall Street Journal about a coming gold revaluation, hinting that Washington itself may be preparing to back future CBDCs, central bank digital currencies, with gold. Under Basel III, gold is now officially classified as a high-quality liquid asset, equal to cash on a central bank's balance sheet, which means when the reset happens, gold's price could be re-rated globally to recapitalize sovereign debts. And what about silver? Mario calls it gold's younger, more explosive brother. Unlike gold, silver faces chronic shortages. Industrial demand in electronics, medicine, and defense now exceeds mine supply year after year. The U.S. government even labeled silver a critical mineral and recently set aside $4 billion for silver stockpiling and new domestic mines to reduce dependence on Chinese refiners. That's why authorities try to keep silver below $50 per ounce. A breakout above that level could expose the system's fragility. But Mario insists, once silver decisively breaks $50, the market unlocks the final boss. At that point, suppression becomes impossible, and silver could run freely to its real valuation. All signs point to a controlled transition. Governments and megabanks like JP Morgan, HSBC, and Citigroup are quietly helping sovereign clients accumulate metal behind the scenes, preparing for a reset where gold replaces paper as the world's ultimate measure of value.
If you look at the longer term, gold has been in a 25-year bull market. Silver, not quite 25 years, but it's starting to follow as its younger brother. And silver has a little bit more explosive upside because it's used more industrially. So we're actually running shortages from what the mines are producing to what we actually have. So I think the silver situation is going to come to a head faster than the gold situation. But the good news is, over the last 25 years, gold has followed very closely the CPI index over that period of time. Now, most of us don't believe that CPI is the real inflation rate, but the traders do pay attention. So even though I don't want people to panic, because even though we have all of these factors going on and it looks like gold has this $300-400 fall, and silver has, $4 or $5, $6 fall in a very short period of time, a lot of that is just rebalancing. It's rebalancing, one, the futures trade and the OTC trade in London. Two, it's rebalancing the risk of London not having enough silver and the COMEX sending bars over to help bail them out. And three, it's rebalancing ahead of these trade deals and other deals that are going on in the economy. And four, the sovereigns don't want gold and silver to run too quick because they're not ready with the CBDCs. So what they're trying to do is manage that trade. And that's how I know a lot of the sovereigns are in using JP Morgan, Bank of America, HSBC, Citibank to do these trades. Under the cover of those banks to do it for them, because they're trying to manage movement into this new CBDC system. Now, if we look at CBDCs and digital IDs, they're probably going to be really ready for prime time in a couple of 3 years. They're being rolled out and tested right now. So I expect that this kind of shenanigans in the gold and silver market to continue by the sovereigns intervening in it, much like they intervene in the Forex markets and the Treasury markets and the stock markets and the bond markets. They're going to continue to do that until the new system is ready. Now, I threw a whole bunch of stuff at you, but that's really kind of the calculus that you need to have when you look at these markets. And the one thing for precious metal stackers to understand, especially if you're new to this space and you're just learning, it's not dependent on the physical trade at your dealer or from APMEX or from Miles Franklin. It's really dependent on these derivative markets that sit on top of the precious metals. So just because the precious metal price comes down, you have to look at these other intervening factors more than you do what is the worth of your metal in dollars. And the last thing I'll say, and this sort of extended answer to your question, is at the end of the day, while we measure precious metals in dollars or pounds or yuan, at the end of the day, with Basel III elevating gold to a high quality liquid asset on par with cash and bank stock at the central banks, really eventually we're going to measure everything in gold. And that's why the central banks have been buying so much gold. And when they flip that switch to CBDCs, they're going to reset the gold price in the US and around the world to capitalize those CBDCs as the new currencies and to allow them to write off all the old debts. That's why Judy Shelton was on Twitter this week saying that we should do a gold-backed treasury, because what they want to do is back the treasurers with gold when they're ready to do the CBDCs, reset the gold price, and bring all of that debt down or write off a lot of that debt using the nation's gold and other things like cryptocurrencies and Bitcoin. So when you see silver breaking $50, that automatically sets off alarms with authorities saying, wait a minute, we don't want that to get too high for two reasons. One, they use a lot of silver in everything, including missiles, medical, all that kind of stuff. The U.S. government, as I've been expecting for many years, named silver a critical mineral this summer, and the U.S. government just spent $4 billion in $1.5 billion of that buying silver for its own coffers so it can feed its military and other uses that the government uses, and $2.5 billion of that goes into the development of new silver mines and new silver processing here in the United States. Trump also just recently agreed to an $8.5 billion deal with Australia concerning rare earths. And several billion of that is going to go into rebuilding the supply chain, not only buying the rare earths, but building the supply chain to get off of Chinese dependence on processing, which they hold over 90% of processing of most critical minerals in the world. So, yes, we need cheaper prices for silver for industry. And we also need to control that. Well, the government feels like it needs to control that price so that it doesn't expose the dollar too quickly. So there are two major reasons for that. And in the background, the U.S. government is trying to spur the growth in silver discoveries and silver development, as well as other critical minerals on its critical minerals chart. And that is a benefit to the public that they do it. It may be frustrating to investors. It's certainly frustrating to me, but I can see the reasons why they're doing it. Now, eventually, we all want that to end. But again, I have to urge caution, as I've said on your program before. We don't want it to end too quickly because, Elijah, only about 2 to 3% of Americans really invest in the precious metals. We need to get the education out and those numbers up so that more people have them, so that when reset comes, it benefits more people. So I always look at these pullbacks, even though they're frustrating to people, as a blessing in disguise, because it allows more people to get involved in the precious metals and dollar cost average their way in at cheaper prices as we go, up into the higher regions. But yes, that $50 level is critical. And what it's mean is we basically unlocked the big boss in a video game, meaning silver can run as far as it needs to run now. Now, they're not going to just let it run completely, like I said, but silver's not going back to the days of $25 silver. It's just not going to. It's going to continue to run. The governments around the world are going to try to continue to manage it, and the big traders are going to do it for them and make money on those derivative trades, and that's their benefit for helping out the sovereigns and other players in the field that don't want those prices to rise too fast. But if you're a stacker in the physical, or if you're storing it, or if you're using a digital version of it, that gold and silver, that's a blessing to you. If you like gold and silver, buy more when you have these dips. That's a perfect time to get in.
Here's Mario Innecco's message to gold and silver investors, crystal clear and urgent. The world is shifting from paper wealth to physical truth. Central banks know it. They're not speculating. They're securing survival. If you're holding gold and silver physically, you're on the right side of history. If you're still relying on paper contracts or fiat cash, understand this. When central banks reprice gold to back digital currencies and write off their debts, those paper promises may vanish overnight. Right now, fewer than 3% of Americans own any precious metals. That means 97% are completely unprepared for a monetary reset that could reprice everything, from your savings to your retirement, in ounces of gold, not dollars. So ask yourself this simple question. When the reset comes, will you be holding paper or real wealth? Mario's advice is simple. Use these corrections as opportunities. Accumulate, stay patient, and remember, the system's volatility isn't a sign of weakness in gold or silver. It's a symptom of the old monetary order breaking apart. If you found this analysis helpful, smash that like button, subscribe, and turn on notifications so you don't miss the next big update on the global shift from fiat to real money. And now, I want to hear from you. Do you believe central banks are preparing for a gold-backed reset? Drop your thoughts in the comments. I read everyone, because the moment of truth for gold and silver might already be here.